I think people are very worried about how big of an impact this is going to be to next year's earnings. And if you size it to be $500 million or so, worst case, the stock is just too cheap, right? So it's sold off on what were kind of weakish, quarter. We expected that. But Disney's engines are really strong. Parks are strong. Film is strong. ESPN was a weak year, but we're going to get some better news in the next couple of years in terms of a new affiliate fee cycle.
So does that price in then a turn in cable operating income, or what kind of uptake does the new service need?
Okay, so what's funny about this year was they had a big NBA step up, and this NBA step up in costs killed profit. The NBA step up is now anniversary. So you're looking at a more, I'd say, flattish growth trajectory for ESPN. And I think people think it's going to get a lot worse, but we don't expect it to get a lot worse because the cost base is now behind you. The opportunity is, or the risk would be in 2021, that's when the next NFL deal kicks in, and that's going to be expensive. And the question is, how big will the revenue base be at that point?
With some big buyers in the market as well.
Oh, without a doubt, yeah.
David, what about you? Are you that optimistic?
Well, first of all, just for sake of disclosure, I have to stick with my published comments. I can only just extrapolate on questions where, I've already answered that question in written form. But, we downgraded this stock back in mid-April at 114.44. At the time, the stock was trading at 10 times EV to EBITDA. It was trading at 17 times earnings on the out year. That's enough for us. That's expensive enough. And we're not surprised to see the stock down here at the kind of the $102, $103 level. Still too expensive for us. The stock is rated hold here at Loop Capital.
Michael, the larger implications of this direct-to-consumer initiative that Disney is undertaking and the ecosystem that we've been talking about and you've been writing about now for years coming apart. Give me your sense there. I mean, can Disney really pull off direct-to-consumer? This is not their typical business.
Right.
And there's a lot of questions amongst the investor base as to whether or not this is, and Jim said, this a Hail Mary pass.
Well, okay, there are two different initiatives, so let's separate them out. On the film side, taking Disney's content direct-to-consumer, given the brand, given the IP, given the loyalty people have to Disney's brand on the film side, I don't think it's a crazy idea, right? I don't think it'll be that disruptive to our business models, right? You've seen HBO do it, Showtime do it. You can go direct-to-consumer on film. The sports pivot is more nuanced. They're not taking direct-to-consumer ESPN. They're building a intense fan product to go direct. That, to me, will not be as disruptive. The question will be, if the bundle keeps creating more and more, less subscribers, do they go over the top with a bigger ESPN heavy product?
What is the proposition going to be as a consumer at home for all these different services that I may or may not want to subscribe to?
Right. So
it's going to be impossible, it would seem. I might find myself saying, God, I kind of like that bundle.
Right. Well, what's funny is we keep doing this, quarter-cutting analysis, and what's happening is the big bundle subscribers are leaving the system at a 3% a year clip. So traditional bundles are leaving pretty quickly. If you add it all up, the smaller bundles are taking, let's say, 50% of that decline rate. Yeah, what's going to happen longer term is you're going to have two types of consumers. One that like a big bundle, maybe it's half the market. The other will be purely a la carte, right? And that's going to be the time at which Disney and everyone else says, do we go direct to consumer? We're not there yet, but you're laying the groundwork for a time when half the world's going to say, I don't want 500 channels. I want less. I want to pay less.
It appears, David, and I'll put this to you, that there's a little bit of a visibility problem. I mean, Iger wouldn't comment on the pricing of these new services. We don't know exactly how much they're going to lose from the licensing fees they've been collecting, right, from Netflix. I mean, how do you actually build this into your model without knowing exactly what the profitability implications are going to be?
Yeah, I mean, sure, that's the analysis that everyone has to do. I mean, how are they going to price this thing? Is it going to be $6.99, like CBS All Access? Is it going to be like $14.99, like HBO Now? That's the question that was left unanswered on yesterday's call. And further, the piece of analysis that everyone has to do is, how many core MVPD subs are they going to lose versus how many over-the-top subs are they going to gain? Right now, with the stock reacting the way it is, it would seem like, everyone's sort of surprised by this. But keep in mind, it was a year ago. I think people are forgetting it was a year ago that they announced their intention to create an ESPN over-the-top service with their initial BAMTech investment. So, again, I'll just go back to my published comments. We think the stock is down on the quarter, not on the ESPN over-the-top announcement.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.